Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, it was an excellent week on Wall Street. Right from the beginning, there were gains to the end of the week with the news that Microsoft may well be buying out the internet giant Yahoo. And this really lifted the markets again on Friday after a disappointing employment report. In fact, the contraction of 17,000 jobs this month was the first reduction in the labour market for 4 years. But of course, it was the Federal Reserve's meeting where another half a point, in fact 50 basis points, was cut off both the Fed funds rate and the discount rate. That really made the difference to the markets this week, and adding another rate cut on top of the Fed's emergency cut a couple of weeks ago really gave the market something to cheer about. And really there's been very little for the market to cheer about in the last few weeks. The employment report this week just adding to the problems, but the fallout from the mortgage and loans industry is still there. In fact, talk of emergency measures to bail out bond insurers this week, adding to the financial woes. Well, we'll see how long the euphoria lasts for the markets, but certainly a recession is the word on everybody's lips at the moment. Let's take a look at the Nasdaq Composite Index chart, and we'll see how this downtrend is really shaping up. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas, we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark at 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here. And that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback of consolidation over the next few weeks, before then the market would probably turn southwards again. So we've seen the classic head and shoulders pattern forming over the last 6 months, and we've also seen this penetration of the long-term moving average line, which is also a bad sign going forward. So after another maybe few weeks, possibly 2 months at the best, a consolidation period, we do expect the market to turn south again, continuing the downtrend and continuing what is a bear market, certainly a bear market now we feel forming and in place for the next few months. How long this will continue, of course, depends on the American election year developing politically and whether the signs going forward are positive for the market, in which case the market may well pull itself out of the doldrums a little bit sooner than we would normally expect. Bear markets typically last between 9 months up to 2 years. Let's hope, of course, this one will be on the short side. The signs from the economy, though, are still very, very weak, and the fallout from the mortgage and loans crisis is still by no means over. Still more bad news, I'm sure, to come out. But the news from Microsoft at the end of the week trying to acquire Yahoo may well start a new round of mergers and acquisitions, which is always good news for the market. Going forward, this could be something that will help to stabilize the situation and offset the deteriorating economic news. And the earnings season hasn't been that bad considering. So we'll keep a close eye on the whole situation for you. Until next week, it's goodbye from London.